but if you have to do it, do it. Interest rates on some Canadian mortgages are up by as much as 250%, and half of Canadians say that they are worried about their payments upon renewal. But what about those people who took variable rate mortgages who are already feeling the pain? Is there anything that can be done to help them? Well, the answer is yes, mortgage bailouts are coming. But before we get into the details, my name's Nolan Matthias, and if you want to thrive financially, this is the place for you. So go ahead, click that subscribe button, and hit that like button so more people like you can see this video. Okay, so let's talk mortgages. A lot of people already have mortgages that have payments that have increased quite substantially. If you are a variable rate mortgage holder with an adjustable payment, you've already felt the pain of this. And if you're a variable rate mortgage holder with a fixed payment, you've probably already been in touch with your lender, or your lender's been in touch with you, telling you that you probably need to do something to increase your payments or make a lump sum payment in order to make sure that you don't have a huge payment at renewal and that you don't end up negative amortizing. However, for a lot of people, it's not as simple as just throwing a whole bunch of cash at the mortgage, either monthly or in a lump sum. A lot of people are really feeling the pain of higher payments and higher costs of living. And while many assumed that people were just going to have to deal with greater financial stress, lo and behold, we found out this week that certain insurers and lenders are helping Canadians to make sure that they don't find themselves in a negative amortizing position or a position where their payments are just too much. And this news started earlier this week when Sagen, the #2 mortgage insurer in the country, released a lender update giving lenders guidelines on what they can do without even talking to the insurer in order to help consumers that are feeling the pain of higher payments. And this is really quite interesting because there are some remedies here that I never thought I would see happen. Well, actually, I kind of thought it might be something that I would see happen, but I didn't think I would see it happen this soon. And that is extension of amortizations for certain consumers. So I want to jump you in. I'm going to show you the actual document here. This is the lender update from Sagen, and the subject is default management update to support homeowners impacted by rising interest rates. And what this is this is guidelines to help people who are finding themselves in a tough position either with their variable rate mortgages or upon renewal on their fixed rate mortgages. And the guidelines are really interesting because what they are is really simple. If somebody's debt servicing ratio starts to exceed 39% at the time of renewal or any time throughout the term, what Sagen is saying to the lenders is you can go ahead and you can extend their amortization by 15 years up to a total of 40 years in order to bring their gross debt servicing ratios back down to 39%. So what does this mean? Well, what it means is that they're going to start taking a look at homeowners' incomes and making sure that they can still afford the mortgages that they have. And this is up to 39% of their incomes going towards total mortgage costs. Now, before I get into the criteria here, I want to show you real quickly how debt servicing ratios are calculated. This is from the CMHC website, the other big mortgage insurer in Canada. And what we're looking at here is the gross debt service formula. So what you want to do is you want to take your mortgage payment, that's the principal and interest portion of this formula, and you want to add in your taxes and your heat. Now, for most houses, assume that you're going to have about $150 per month in heating bills. That's the general rule of thumb in the industry, as you use $150 for that amount. And then you divide that by your gross annual income. And if the number that shows up is greater than 0.39 or 39%, then you would potentially qualify for some help from the insurers. Now, going back to the guidelines that have been set out by Sagen, amortization extensions apply to the following situations: VRMs and adjustable rate mortgages, so variable rate mortgage both with fixed payments and with variable rate payments, impacted or that will likely be impacted by interest rate increases during the term or at renewal. So in other words, if you find yourself in this situation where your GDS is greater than 39%, either in the middle of the term or at renewal, then you potentially qualify for this. And then VRMs that require payment reset due to breach in trigger point. So in other words, the outstanding balance exceeds 105% of the original mortgage amount. Now, CMHC is using the same 105% guideline as well. And then mortgages at renewal, regardless of rate type. So if you have a fixed rate mortgage, your interest rate increases and that pushes your debt servicing ratio above 39%, you would also qualify for this. Now, there's some other criteria here. You can increase for longer than 15 years. And if you're applying for this relief within the first 12 months of your mortgage, they use the original income amounts that you had at the time you got the mortgage. And if it's greater than 12 months since the mortgage began, then you're going to have to provide new employment documents to prove that you're actually in financial hardship. So there's going to be some work to be done here. But what's really, really interesting is that Sagen is allowing the lenders to do this without bouncing it off of Sagen first. So in other words, the lenders can just, under the guise of the insurance policy that they have on file, go ahead and extend amortization as long as they put together a report on the fact that the person they are doing it for is in a financial hardship situation. Now, the question is, what is going to happen with other lenders? Well, OSFI came out in a Financial Post article here in the last couple of days, and they said that lenders can do the same thing on non-insured mortgages, assuming that the mortgages remain within the lender's risk profile. So at the end of the day here, what we're seeing is we're seeing lenders and insurers get together and say, okay, people's payments are going to go up. It's going to be hard for them to pay their mortgages, so let's give them some relief. Now, what's really interesting here is this is opening up the door to 40-year amortizations again. Not for people who are buying new properties, but people who buy properties, qualify at 25-year amortizations, and then find themselves after the fact in a situation where they're facing financial hardship. Now, there's a whole bunch of other things that we have to pay attention to here. What you have to take note of is if you use these relief guidelines, it's probably going to affect your mortgage down the road. First and foremost, in the form of higher interest rate. Second, in the form of not being able to move to a different lender at the end of the term, which could make it so you have to pay a higher interest rate because you were stuck at the existing lender that you have, unless you have enough equity in your property to refinance. Now, don't count on that, because with property values going down in the big cities in Canada like Vancouver and Toronto, there is a very, very good chance that you won't have the equity to refinance, because you need at least 20% equity to do that in Canada at this moment. Now, down the road, could we see refinances re-available with places like CMHC and Sagen like they were in the early 2000s? This is very, very, very much a possibility, but we won't know until we know. But here's the good news. If you have a mortgage, a variable rate mortgage or a fixed rate mortgage, fixed payment, adjustable payment, there is potential relief in sight. Don't use it unless you need it, but if you do need it, you can rest assured that your lenders and the insurers are going to be willing to work with you and help you out. Now, the bad news is if you do need that relief, it's going to cost you a significant amount more in interest over the life of the mortgage, and it means it's going to take longer for you to build up your equity. But if you have to do it, do it. And if you do find yourself in a situation where your payments just seem like they're too much, go and check that calculation out. It's super easy to do, and I'll link in the description to the CMHC website that tells you exactly how to do that. And by the way, the CMHC method of calculating debt service ratios is pretty much standard in the industry, so regardless of which lender you're at, they're more than likely using that exact calculation. And in addition to all of this, I put out a video this week. It now has over 105,000 views that talks about how the Bank of Canada is going to start to bring the pain. I'm going to link to that video right here if you are in a variable or a fixed rate mortgage, or you have a mortgage of any type whatsoever. Because again, if you have a fixed rate mortgage, you need to be paying attention to this stuff as well. Check out that video so you know exactly what's happening with interest rates.